Welcome to the deep dive. Today, we're diving right in, headfirst, into the, incredibly complex global financial markets as they stand on June 18th, 2025.
Yeah, things are moving fast.
Absolutely. Our mission, like always, is to sift through that mountain of raw intelligence, the reports, breaking news, central bank statements, and really boil it down.
Distill it into something clear.
Exactly. Clear, actionable insights just for you. Think of it as your shortcut to being genuinely clued in, maybe with a few surprises along the way.
And today is a really pivotal day to be doing this. We're looking at a pretty tumultuous market environment.
Tumultuous is putting it mildly.
Right. You've got these sharp geopolitical tremors, especially coming out of the Middle East, sending, undeniable shockwaves. And at the same time, we're right at this critical point with decisions from the big central banks, particularly, the U.S. Federal Reserve. So our goal today isn't just about listing what's happening. We want to help you understand why it matters, how all these different forces are kind of meshing together, and what that means for, assets across the board.
Okay, let's try and unpack that then. The big driver, the thing really shaping market mood today, June 18th. It seems to be this sharp escalation in the Middle East conflict.
No doubt about it.
We've got confirmed reports, Israeli air attacks on Iranian nuclear sites, key personnel.
Yeah, serious developments.
And then there's the rhetoric, right? Very charged language from the U.S. administration. President Trump apparently leaving the G7 early, calls for Tehran's evacuation. I mean, that's not just background noise.
No, that's front and center. It ejects a whole lot of alarm into what was already a pretty fragile global picture.
So how have markets reacted? Is it just straightforward panic?
Well, the reaction itself has been pretty much a textbook flight from risk. But, as we'll get into, there's a surprising twist, especially with the dollar. But let's look at the direct impacts first. Crude oil, West Texas Intermediate, specifically, it surged over 5.2%. We're talking $75.50 a barrel.
Wow.
And this isn't just simple supply worries. It's that dual fear.
Yeah.
Physical damage to infrastructure and the strategic risk. Critical shipping lanes like the Strait of Hormuz potentially closing.
Right. That's huge.
It is. And for economies that import a lot of energy, that immediately means inflationary pressure. It's a direct threat to global growth.
So oil's spiking. What about stocks? Equities usually hate this kind of uncertainty. Are they just diving across the board?
Mostly, yeah, but not quite uniformly, which is interesting in itself. Globally, equity markets definitely took a hit. In the U.S., you saw all S&P 500 sectors down, except two. Energy naturally was up 1.0%.
Makes sense.
And defense stocks, they jumped almost 3.0%. So it's a clear rotation, right? Money moving into assets that might actually benefit from conflict and higher oil prices while the broader market pulls back.
And the fear gauge, the VIX?
Oh, yeah. The VIX shot up, jumped 13% to 21.60. That's a pretty significant spike, telling you investors are seriously bracing for more choppiness in the near term.
Okay, so we have this geopolitical storm. But layered on top, like you said, is this week of really key central bank activity. And this is where it gets really interesting, doesn't it?
Absolutely. It creates this complex, sometimes contradictory policy picture.
Let's start with the big one, the U.S. Federal Reserve. They're wrapping up their meeting today, June 18th. What's the situation there?
Right. The FOMC decision is due. Now, the market's pretty much certain, like 99.9% probability priced in that they'll keep the Fed funds rate where it is, 4.25% to 4.50%.
So the rate decision itself isn't the main event?
Not at all. All eyes are on the forward guidance, specifically the updated economic projections, the SAP, or what everyone calls the dot plot.
Ah, the dots.
Exactly. The real worry, the market anxiety, is about a potential hawkish surprise.
Meaning
the dot plot might signal fewer rate cuts for the rest of 2025 than the 25 basis point cuts the market's currently expecting.
And why would they do that, given the risks?
Well, the thinking is persistent inflation worries. Those worries are now getting amplified by this surge in oil prices we just talked about, plus ongoing uncertainty around U.S. trade tariffs. It pushes them towards maybe being a bit tougher on inflation.
But that hawkish surprise, that really puts the Fed in an incredibly tough spot, doesn't it? It's like Chair Powell's walking this tightrope.
Absolutely. Blindfolded, maybe?
Yeah. Trying to...
Pretty much. Any choice involves a big trade-off. And that's exactly why Powell's press conference later today is going to be watched so closely. Every word, every nuance will be picked apart.
People hanging on his every syllable to see which risk they fear more, inflation or the slowdown.
Precisely. Which one does the committee see as the bigger immediate threat? That's the billion-dollar question.
Okay, so the Fed's in this unenviable bind. How does that compare to other major central banks? Are they all facing the same thing, or are we seeing real differences emerge?
Oh, we're definitely seeing clear divergence, and that's a huge theme today.
Okay.
Look at the European Central Bank, the ECB, a really stark contrast. At their meeting back on June 5th, they actually cut rates by 25 basis
Wait,
points.
they cut to 2.000%.
Yeah, the deposit rate went down to 2.00%, and that was driven by them lowering their own forecast for inflation and GDP for the next couple of years. It really cemented a more dovish stance.
Although Lagarde did sort of hint that might be it for cuts for a while.
She did. She gave that sense of maybe a dovish but with a hard floor. But even so, it's a sharp contrast with the Fed, which seems to have less room or maybe less willingness to cut right now. And that fundamental policy difference, it really favors the euro.
Interesting. And Japan, the Bank of Japan, always kind of his own story. What's happening there?
Well, the BOJ, they met on June 17th. They kept their key rate at 0.5%.
Still super low.
Very low. And they outlined a plan for only a very gradual reduction in their bond buying. So they're sticking with that ultra-loose policy.
Which keeps the yen cheap for carry trades.
Exactly. It solidifies the yen's role as that low-yielding funding currency. Borrow cheap yen, invest elsewhere for higher returns. But, and this is important, the yen's traditional role as a safe haven. That's being seriously tested right now.
How so?
Because of the geopolitical stuff, sure, but also because there's clear evidence of significant capital actually flowing out of Japan. Investors are chasing those higher yields or maybe looking for, genuinely safer assets somewhere else.
Okay, that's a really complex picture with the central banks. Let's broaden out again. Talk about the overall economic pulse and market metrics. You mentioned a twist with the US dollar index, the DXY. It's not behaving like a typical safe haven.
Yeah, this is fascinating and really critical to understand. Normally, in this kind of risk-off environment with geopolitical tension flaring, you'd expect the DXY to rally strongly, capital rushing into the perceived safety of the dollar.
Right, that's the usual playbook.
But it's not happening. The index is actually trading near multi-year lows. It's hovering down around 98.60 to 98.80.
So why the weakness?
It strongly suggests the market is pricing in a significant U.S.-specific risk premium. Maybe concerns about domestic policy uncertainty, the fiscal outlook, something specific to the U.S.
So the dollar itself is seen as part of the risk, not the refuge from it.
Exactly. That's a profound shift in market dynamics. And it has huge implications because it creates this, permissive environment for other currencies and assets, think the euro, think gold, to actually appreciate, even when global risk aversion is high.
Wow, that really does turn the usual script on its head.
It absolutely does.
And quickly, any other supporting metrics we should be aware of? Commitment of traders, funding markets.
Yeah, briefly, the Commitment of Traders report, which shows institutional positioning, that gives us clues about where the big money is flowing. Short-term funding markets, like SOFR, they seem stable for now.
Yep.
And those safe haven flows we are seeing, they've pushed the 10-year U.S. Treasury yield down to around 4.385%.
Okay, so lots of moving parts.
Definitely. And it's by looking at how all these pieces fit together, especially through our sort of macro matrix of specific currency pairs, that we can really start to decode which forces are actually winning out right now.
Right. So to give you, our listener, those clear, actionable insights, we don't just pick pairs randomly. We run them through a pretty rigorous selection process.
A weighted scoring model.
Yeah, exactly.
Yeah.
We prioritize volatility and event risk that gets 40%, then liquidity gets 20%, anomalous sentiment like those weird retail positions gets 20%, and the technical picture gets the last 20%.
It's designed to surface the pairs where the macro story is playing out most clearly.
Precisely. It's our macro matrix to help you figure out what's really driving things in real time.
And based on that process today, we've picked 5 pairs to really dig into. Each one tells a slightly different part of the story.
Okay, what are they?
We've got USD, that's the Fed versus ECB divergence play. Then USDGPY, which is that battle between policy divergence and safe haven flows we talked about.
Okay.
GBPJPY, that's more of a pure read on global risk appetite.
Yeah.
USD CAD, that's the direct hit from the oil price shock.
The commodity play.
Right. And finally, USDZR, looking at emerging market resilience and, those high-yield EM dynamics.
Okay, 5 key pairs. So what does this all mean for them specifically? Let's break down the analysis layer by layer, starting with USD.
Okay, USSD. What we're seeing here is an exceptionally strong convergence of bullish signals. It's quite striking.
Bullish, despite the global gloom.
Yeah. Technically, it's in a clear, sustained uptrend. It's currently consolidating around the 1.1500 level after hitting that multi-year high recently at 1.1632. Importantly, it's holding comfortably above key moving averages, which confirms the momentum is still strong.
And fundamentally.
Fundamentally, it's all about that powerful monetary policy divergence we discussed. The ECB cut to 2.00%, the Fed's at 4.25%, 4.58%, but crucially, they're expected to signal cuts coming later this year. That narrows the interest rate gap, making the euro relatively more attractive.
And Eurozone data, is that helping?
It is. We've seen stronger data out of the Eurozone, like the German ZEW Economic Sentiment Index surging to 47.5. That adds another tailwind.
Okay, so technicals and fundamentals lining up. What about positioning? Where's the money flowing?
Quantitatively, looking at order flow, the institutional smart money, think asset managers, leverage funds, they're heavily net long Euro FX futures. That points to a real structural shift in allocations.
So the big players are betting on the euro. What about the retail crowd?
And this is where it gets really interesting from a contrarian perspective. Retail sentiment is overwhelmingly bearish on the euro. Forex.com reporting 80% short, IG showing 62% short.
Wow, that's extreme.
It is. And often, that kind of extreme positioning is a powerful contrarian indicator. It basically sets the stage for a potential short squeeze.
Where the shorts get forced to buy back, pushing the price up.
Exactly. And remember that weak US dollar index we talked about, the fact that it's not rallying despite the high VIX.
Yeah.
That removes what would normally be a major headwind for USD, allowing it to potentially climb more freely.
Okay, so for USD, pulling it all together, the directional bias looks strongly bullish.
Agreed.
The potential 24-hour price zone we're looking at is 1.1475, 1.1640.
Sounds about right.
And our confidence score, maybe an 810. The only real question mark being that FOMC decision, the binary risk there.
Yeah, 810 feels right. It's a strong setup. Just need to get past the Fed announcement.
The key takeaway for EURUSD is that even with global turmoil, the euro seems positioned to gain, driven by that policy divergence and the surprising dollar weakness.
Okay, next up, USD/JPY. You describe this one as being caught in a tug-of-war.
Yeah, it really is. It's in a tense equilibrium. Technically, it's right at a critical point. You see a bit of a short-term recovery, but it's happening within a longer-term downtrend. It's kind of coiling up in a triangle or wedge pattern right around that big psychological level of 145.00.
And fundamentally, what's pulling it in different directions?
Well, the biggest factor pulling it up is that massive difference in interest rates. The Fed at 4.25%, 4.50%, the BOJ at just 0.5%. That makes a carry trade, borrowing cheap yen to buy dollars, incredibly attractive.
And you said capital's flowing out of Japan, too.
Yeah, there's solid evidence of significant capital outflows from Japan. With investors chasing those higher yields elsewhere, that reinforces the upward pressure from the carry trade. But what's pulling it down, then? Is the yen's safe haven status completely dead?
It's definitely being tested, maybe overridden by the yield difference in those outflows right now, but it's still there in the background. If risk aversion really spikes dramatically, you could see some haven flows back into the yen.
How's sentiment looking? Is everyone betting on the carry trade?
Sentiment is actually really split. Retail traders on IG are basically 50-50, half long, half short. That shows real indecision in the market.
And institutional positioning.
The larger institutions, looking at futures data, are significantly net short the yen. So the consensus among bigger players is for a weaker yen. However, and this is the risk, that makes the pair vulnerable to a sudden reversal, a short squeeze on those yen shorts, if risk sentiment were to suddenly shift and force those carry trades to unwind quickly.
Okay, so lots of conflicting forces there. For USD/JPY, the directional bias seems kind of murky. Maybe sideways bearish longer term, but trapped for now.
Yeah, that feels right.
Oh, no.
Sideways to maybe leaning slightly bearish given the long-term trend, but very susceptible to news.
Potential 24-hour price zone, 114.000, 145.45.
Reasonable range, yeah.
Confidence score feels lower here. Maybe a 610 because those drivers are really pulling against each other.
Agreed. 610 reflects that uncertainty. It's a tricky one right now.
Okay, let's move to GBP/JPY. You called this one a pure barometer for global risk appetite. What's it telling us now?
Well, this high beta cross, meaning it tends to move more sharply with market sentiment, is actually showing pretty strong signs of a bearish reversal.
A reversal? It had been quite strong, hadn't it?
It had. But technically, it failed pretty convincingly up near multi-month resistance around the 196.0 level.
Okay.
And it formed what's called a bearish engulfing candlestick pattern. That's often a strong reversal signal. Looks like a bull trap buyers came in, pushed it up, then got slammed back down.
Any other technical signals?
Yeah, momentum oscillators like the RSI are starting to turn down from overbought territory.
Hmm.
That adds weight to the idea that the upward move might be over.
And fundamentally, how does the risk-off mood play in?
Fundamentally, while the Bank of England's rate at 4.25% offers a yield pickup over the BOJ's 0.5%, the market is actually pricing in more Bailey cuts down the line. UK inflation is still high, 3.4% year-on-year, which gives the pound some support. But the really critical factor right now is that global risk-off sentiment we keep mentioning, driven by the Middle East. That strongly favors the safe haven Japanese yen, putting direct downward pressure on a risk-sensitive pair like GBP-JPY.
Got it. So risk aversion trumps the yield difference here. What about positioning? Is the carry trade crowded in GBP-JPY too?
Yes, that's a key risk factor. We're seeing crowded institutional positioning long sterling, short yen, banking on that carry trade. If sentiment really sours, unwinding those trades could accelerate the move down.
And retail. Are they fighting this potential turn?
Interestingly, retail traders are heavily short GBP-JPY, about 61% short on IG. Now, sometimes the retail crowd is wrong, but at a major potential turning point like this, especially with confirming technical signals, their positioning can actually become a right-way signal. The smart money might be agreeing with them this time.
Okay, so for GBP-JPY, the signals point towards bearish.
Yes, the bias is definitely bearish.
Potential 24-hour zone, 193.65, 195.70, giving it room to fall, but acknowledging resistance.
That range makes sense.
Confidence here feels a bit higher based on the technicals and risk mood. Maybe a 710.
I'd agree with 710. The combination of technicals, risk, sentiment, and that vulnerable positioning makes the bearish case quite compelling.
Right. Next up, USD CAD. The oil play. What's the story?
USD CAD is still grinding lower, continuing its bearish trend overall. But there's a little caveat. It might be due for a short-term corrective bounce.
Okay, technically so.
Technically, yeah, it's clearly in a downtrend. It just hit a fresh yearly low down near 1.3539. However, looking at the RSI, the Relative Strength Index, it recently dipped into oversold territory.
Suggesting it might be a bit stretched to the downside short term.
Exactly. It could be due for a bit of a relief rally, a bounce, before potentially hitting lower again.
And fundamentally, still all about oil.
Primarily, yes. That surging WTI crude price, now over $75 a barrel, is a massive positive for the Canadian dollar. Canada is a major oil exporter, so higher oil prices act as a strong headwind for USD CAD. It pushes the pair down.
Anything else supporting the TAD?
Yeah, we've also seen weak U.S. data recently, like those retail sales numbers, contrasting with pretty upbeat Canadian jobs data. That adds another layer of support for the CAD against the USD.
Makes sense. Now, sentiment. This seems to be a recurring theme. What are retail traders doing in USD CAD?
And it's another really strong signal here. Retail traders are overwhelmingly long USD CAD. We're talking 82% long on Forex.com, 63% long on IG.
Wow, they're really fighting the trend.
Massively.
Wow.
And that provides a powerful contrarian bearish signal. The market often moves in the direction that causes the most pain to the crowded retail position. So the path of least resistance might actually be further downside, unfortunately for them.
Okay, so despite the potential short-term bounce, the overall directional bias for USD CAD remains bearish. Potential 24-hour price zone. Maybe 1.3540, 1.3690, allowing for that bounce but respecting the low.
That seems like a sensible range, yeah. Captures the potential correction but keeps the focus lower.
Confidence. High due to oil and sentiment, but maybe tempered by that oversold reading. So, 710 again.
710 feels right. The fundamentals and sentiment are strong, but the technicals suggest caution about chasing it lower immediately.
Okay, last pair in our matrix. USDZR, the emerging market play. What's happening with the rand?
With USDZR, we're seeing what looks like a really significant long-term shift towards a bearish outlook for the pair, meaning rand strength against the dollar.
A major shift. What's driving that view?
Technically, the biggest thing is the recent break below a multi-year ascending trend line. That's often a major bearish signal suggesting the long-term uptrend is over.
Any other technical signs?
Yeah, there's also potentially a death cross forming on the charts. That's when a shorter-term moving average, like the 50-day, crosses below longer-term one, like the 200-day. It often signals the start of a significant long-term downtrend.
So the recent move up in USDZR might just be a correction.
Exactly. The current upward move looks more like a corrective rally within what could be a new, broader, bearish framework for the pair.
And fundamentally, what's supporting the rand?
Well, even though the South African Reserve Bank, the LISARB, cut rates recently to 7.25%, that still offers a very attractive real yield compared to developed markets. That keeps the carry trade appealing, borrowing low-yielding currencies to invest in the high-yielding rand.
Okay.
Plus, the broad-based weakness of the U.S. dollar itself is helping. And domestically, the recent formation of a government of national unity in South Africa has probably reduced some political uncertainty, which is also a positive for the rand.
But emerging market currencies are super sensitive to global risk, right? How's the current environment affecting it?
You're absolutely right. It's highly sensitive. The current negative risk tone stemming from the Middle East is definitely a headwind for the rand.
So why isn't it weaker?
Because that concurrent U.S. dollar weakness we've been discussing is acting as a counterbalance, sort of mitigating the impact of the risk-off mood. That's a unique dynamic right now.
And sentiment, let me guess, retail is long.
You guessed it. Retail sentiment is majority long USDZR, about 61% long on IG. So once again, it's acting as a bearish contrarian indicator. They seem to be betting against the bigger macro forces here too.
Okay, so for USDZR, despite the near-term balance and risk sensitivity, the longer-term directional bias is bearish.
So the read, yeah.
Potential 24-hour price zone, maybe 17.68, 18.08, allowing for volatility but leaning towards rand strength.
Seems reasonable given the context.
Confidence here feels a bit lower just because EM is volatile and so headline-driven. Maybe a 610.
Yeah, 610 feels appropriate. Moderate confidence due to that high volatility and extreme sensitivity to geopolitical news. It can swing wildly.
So looking at these 5 pairs together, this macro matrix, it really does help show which forces are winning out, doesn't it? Like the dollar weakness overriding some of the risk aversion.
Exactly. It's like putting on special glasses that let you see the underlying currents in the market. It helps decode what's really driving price action.
Absolutely. So after digging through all this complexity, the geopolitics, the central banks, the sentiment, the technicals, what's the single most compelling, actionable insight? Where's the highest conviction opportunity for you, the listener, in this whole intricate picture?
Okay, based on everything we've analyzed, the highest conviction trade opportunity we've identified right now is actually a long position in Euro USD.
Back to your SED, why does that stand out so much?
It stands out because you have that really strong convergence of bullish factors we walked through. The technicals look good, the fundamental policy divergence is powerful, institutional money is flowing in. And crucially, you have that potent contrarian signal from the extremely bearish retail sentiment. We're basically anticipating that the FOMC message today will be dovish enough, or at least neutral enough, not to derail the euro's underlying strength. That should act as the catalyst.
Okay, that makes a lot of sense. It sounds like a really well-supported setup. Can you give us the specifics, the recommended strategy, details, entry, targets, stop loss?
Sure. So the strategy would be to look to go long UUSD, ideally on a corrective dip, anticipating a rally perhaps after the FOMC dust settles.
Okay.
The recommended entry price zone we're looking at is 1.1490 to 1.1510.
Got it. And where would we aim for? Take profit.
For a take profit level, we target 1.1625. That's just slightly below the recent June high, which also increases the probability of getting filled.
Okay, sensible. And risk management. Stop loss.
Critically important. The stop loss should be placed down at 1.1445. That sits below some key recent support levels.
So what kind of risk reward does that give us?
If you calculate that out, it gives a pretty favorable risk-reward ratio. It's approximately 1 to 2.5. So you're risking about 55 pips or a potential reward around 125 pips or percentage in point movements.
That's a solid risk-reward profile. Now, you mentioned earlier something about a potential pain trade in USD. Can you explain that concept again and why the current environment actually makes it more likely?
Yeah, the pain trade. In this context, the pain trade for USD would be a sharp, maybe unexpectedly strong move upwards.
Causing pain to whom?
Causing maximum financial pain to that huge crowd of retail traders who are currently short the pair. If the price moves sharply against them, they're forced to buy back their short positions to limit their losses.
Which adds fuel to the fire, right? Their buying pushes the price up even further.
Exactly. It forces them to cover, which accelerates the rally, becomes a self-feeding loop, at least for a while.
And why is the current backdrop, the geopolitical crisis even, paradoxically helping this?
Well, it's because, as we discussed, the crisis is undermining the U.S. dollar's usual safe haven status. In a normal risk-off situation, a strengthening dollar would act like a heavy brake on any USD rally.
Right, it would cap the upside.
Precisely. But right now, because the market seems to view the dollar itself as carrying some risk, that traditional headwind is largely missing.
Interesting.
So it allows the euro to trade more freely on its own positive fundamental story that Fed ECB policy divergence. It makes the potential for that upward pain trade rally even more potent because the usual anchor isn't there.
Oh, wow. What a deep dive indeed. We've definitely uncovered some clear opportunities, some real actionable insights, even with all this global volatility and those intense geopolitical headlines swirling around.
Yeah, it's a powerful reminder, isn't it, that even when things seem chaotic, there are these underlying structures, these market dynamics that create opportunities if you know where to look.
Absolutely.
So maybe a final thought for you, the listener, to chew on. In this world of interconnected markets where you get so many conflicting signals,
Mhm.
what new perspectives did you gain today? How did you see these seemingly separate events, geopolitics, central banks, sentiment, actually converge to shape how assets are moving?
Mm.
And how might that fresh perspective, that new lens, maybe change how you interpret the next big headline or the next piece of financial news you see? Can you look beyond the obvious now, maybe, to see those hidden currents we talked about?
Excellent questions to mull over as you navigate these markets. Thank you so much for joining us on this deep dive into the global financial landscape. We really encourage you to keep exploring this, well, fascinating world of interconnected events and their ripple effects.
Keep digging.
Exactly. We'll be back soon with another deep dive.